Well, good afternoon, everybody, and welcome to the February 22nd Deuces Wild. It's Tuesday. You may have seen notes from friends and family about all the twos in the date today. So we'll spend a moment with that also. But again, welcome back. My name is Mark Robertson. I'm founder and managing partner of Manifest Investing. And Ken Kabula will not be able to join us as he is rolling around on the beaches somewhere in Florida this weekend for the next several days. But I am pleased to share that we have a couple of special guests that you've heard from in the past, and they're back to share thoughts with you today. Sean Mace. Good afternoon, Sean.
Good afternoon, Mark. Happy Tuesday.
And I didn't put your costume and your bio in here. Maybe I'll put that in here in the show notes.
Oh, that's okay. I won't be upset if you forget that.
The Lederhosen. Well, it definitely got a lot of attention when it came out.
Hey, if that's what people want to remember me, and I'm happy with that, that's fine. I'll get some short shorts for people.
And we're joined here also by Matt Spielman. Good afternoon, Matt.
Good afternoon, Mark. Hi, everyone.
And Matt, of course, has been a pretty steady contributor at Manifest Investing and a participant in our successful investing series, and we're certainly grateful for that. Well, again, Deuces are wild. I actually set my alarm for 2:22, so if you hear the alarm go off, everybody should have their beverage. I have some coffee here. We'll actually have an internet toast when we have twos across the board the entire date and time series. But we wanted to just kind of wrap up the inflation discussion. I don't know if we'll be done with it, but certainly kind of capture the highlights and talk about some rules of engagement, kind of reinforcing what Ken and I had to say last week about really you don't do anything different. You keep doing the things that you've been doing. The way that we search for companies and opportunities to study typically does produce the type of a field of view or a perspective that is seeking the right stuff, and we'll show that today. On the subject of bubbles, we'll talk a little bit about Sam Adams, but yeah, it's got just the comprehensive subject of recessions and bubbles and inflation. All that stuff matters. And then we'll cover briefly the fact that we are now shorting stocks at Manifest, and that's all Sean's fault.
And I'll happily do it again.
Okay. A little play on words there. Don't worry, we're not actually shorting stocks, but we are doing features described as shorts on stocks. And we'll share a little bit of, Matt will share a little bit about the company Footprint I'd never heard of, even though there's an entire NBA arena named after them, but let's come to that here in a few minutes. All right. Get the paperwork out of the way. The legal boilerplate, no investment recommendation is intended. This is all about education. We are illustrating and demonstrating the principles, practices, methodologies, techniques of the modern investment club movement as interpreted by Manifest Investing and or championed by the National Association of Investors, known as Better Investing. Everything you hear, though, are our opinions. Please do your own homework and make your own decisions about any stock that you do study and decide to own or not own anymore. If we hold securities, we will try to remember to disclose that in the discussions. We are 1 week out from the roundtable. It's our red carpet, black tie event a week from today. That's a monthly webcast where we simply share actionable stocks to study. And I've been doing it now for 12 years. And the rate of return on our monthly selections, there's usually 4 or 5 every month, with a fairly brief analysis of each of the companies submitted. And the rate of return on those selections going back over those 12 years is approximately 18% per year. So it's actually been quite good. If you'd like to be added to an email reminder list, send an email to nkabula1@comcast.net, and you will get just a few emails keeping you abreast and aware of those sessions as they happen. If you have any follow-up questions or you would like copies of slides, my email address there is markr@manifestinvesting.com. You can go ahead and write to Ken about this particular session, but he'll probably just send back a bar tab or something. So just keep that in mind. Here's a quick look at our standing agenda, some of the topics that we will be covering in future months. We will be moving up the Bitcoin discussion to sometime within the next few weeks. Just some of the stuff that we'll be talking about here today. But for today, we're going to wrap up that and kind of encapsulate the rules of engagement for inflation-influenced investing, tiny bit on Boston beer, including that short stuff that we were talking about, and a few moments with Warren George and Gerald Ford, along with our traditional stops along the way. Any comments or questions, guys?
Nothing here, just following along.
Nope.
All right. Well, I thought I would throw this graphic up again. We do this quite often, probably 75% of the time. And my one thought for today, and basically any day, is please don't be surprised when the green price bars basically return to the blue line. Don't be surprised when that happens. It's going to happen. I don't know when, but they seem to be making a move today to get a little bit closer. Those are quarterly stock price. It's an index based on the value line arithmetic average, which is basically a look at the 1,700 companies in the standard edition. So it is it's an aggregate of those 1,700 stocks covered by value line, and they certainly have been making a move back towards the blue. And again, we should just all promise ourselves that we're not surprised when that happens. The return on the average stock right now is approximately 11%. And that's not terribly unusual. It's kind of back in the zone. So just a reminder that they do zig, they do zag, but they do ultimately return. And that's just what we use to guide ourselves philosophically. All right. All right, and then this is something that kind of came up this morning in conversations with Sean. With all the events that are going on, we couldn't do this today without at least a mention of the disruptive uncertainty in Ukraine and Sean's reaction to it. And I got to agree with him 100%. Is show us on the charts the last time, because they've done it a couple of times. And Sean, I'll let you go ahead and make the point.
Yeah, so last time when, this isn't anything new, when Russia actually invaded Ukraine for the first time, if you write in there that red circle on the bottom right picture, that's the day that Russia actually invaded Ukraine for the first time. Yeah, it looks like there's a little bit build up to it, but it built right back up since. I actually, in the bottom, you'll see this from September. This is from September 2013 through September 2014, and there was still a 21.2% gain in the this is the SPY, or the S&P 500 index. There was still over a 21.2% gain in here. So this is just a small blip. I mean, I'm not concerned about it. This isn't anything new. We've seen it happen before, unfortunately.
Yeah, and
so,
it will be disruptive in a number of ways. There's obviously things to be concerned about. There's nothing good about what's happening, but wow, yeah, there's going to be disruptions. Europe is going to be disrupted. It's probably going to complicate their recovery with a recession that seems to have gone on for a heck of a long time. Matt, I often wonder, when you spent a few years in Ireland, is Ireland pretty much insulated from what's going on the continent, or?
In some ways, they're extra sensitive. They certainly were extra sensitive to Brexit because most of the goods that flow to Ireland actually came across what was called the land bridge from the UK.
Uh-huh.
Whether that was actually manufactured in the UK or just using the channel as a transport and staying on a ship least amount possible, that was a major transportation deal. But of course, I think the biggest thing Europe is worried about, I mean, unless you're on the eastern border, the biggest thing Europe is worried about is energy prices. And in that sense, Ireland has no native energy sources, so they definitely are going to be hit by the rise of cost of natural gas and any implications of any sort of actual shortage if the current pipelines, the current Russian pipelines through the Ukraine are disrupted, and of course with Germany halting progress on the Nord Stream 2.
Right. I mean, that's all a work in progress, and yeah, no one knows exactly what the disruption or what the level of discomfort will be, but there will be something. Almost has to be.
Yeah, better, I suppose, in late winter heading to spring than in fall heading into winter. But
yeah,
it's yet another stop in a world that's full of them.
Yep, tough stuff. All right, and over the last year or so, I have thoroughly enjoyed spending some time with Sean talking about some of the stuff on Reddit. There's some really off the beaten path stuff on Reddit, but Sean actually shared this morning some of the stocks that are suffering off of their all-time highs. And all I've done here is gone in and I circled some that really have been most distressing to groundhog portfolios in the last year. Fiber, or I think that's 59 FVRR down at the bottom. That one really did some damage to portfolios, along with Facebook, of course, Peloton, Robinhood. Although not many of us had Robinhood in our portfolios, but a few of these sneak in. Some of the gaming stocks, AMC, and of course, Boston Beer, which I'll let Sean expound on a little bit there. That one is just kind of off the charts. It is on our best small company list for this year, and we continue to be hopeful about it. But there are some other, I could have circled a few more on here, but wow. Just when you think about the magnitude of the drop and the depth of the disruption, and we will come back to this, Kathy Wood owns a bunch of these.
Yeah, and I'm still all for Sam here regaining that ground back. I mean, I think it's definitely an overreaction to what a lot of people thought of when they missed their sales.
Yeah, so you think that they're going to get repositioned and basically recapture? Yeah. And we'll actually talk about this in a few minutes too. Sean has a quick 45 or 60 second addition to our YouTube page, and we're going to actually start building that out and just kind of tinkering with it to see what we might do. But there's some other names on here that are quite, Proto Labs, a community favorite from a few years ago. This is no fly-by-night company, and I, for the life of me, I can't explain, that big of a drop. We did hail it as overvalued, 12 or 18 months ago, but we didn't think it was that overvalued. And there's just a bunch of companies on here. I was talking to Kim Butcher earlier this morning, and PayPal continues to mystify. I think PayPal is nestled in a very promising area with electronic transactions, and they're certainly a very well-established player, and they're 2/3 off of their all-time high now, and firing on most of their cylinders. So it just shows you the real depth. Now the monkey is there because the gangs, the community at Reddit in the stock area, I don't know if it extends beyond stock, Sean, they actually refer to themselves as apes. And I'm not sure where that comes from. What's the origins?
I couldn't even tell you. I'm a part of the community, and I couldn't even tell you why they decided to go with apes.
So they just decided to be apes.
Yeah. Yep.
Apes are
why not?
Strung together. There's a lot of stuff that goes on there. And I'm not kidding. I mean, there's a lot of chaos and noise, but man, some of the stuff is really, really quite good. And it's just a matter of being able to ferret that stuff out. So
yeah, you'll occasionally find one small gem in there, but it's definitely amongst a lot of noise.
It's some pretty wild stuff. All right, and here's just one other subject I thought we would touch on, because it just shows how I'm not sure who I was having the conversation with. It might have been Sean. I don't remember. Anyhow, the disconnect between headlines and the actual news. Well, it was you, Sean, wasn't it? You were talking about as you dug into the.
Yeah, it was specifically Fedex. As I was digging into Fedex, like just what the 10Q report was showing for their earnings versus what was actually being said in the media were just two different things. And there is a very large disconnect in what is being said in the news versus what the companies are trying to do.
Yeah, and the headlines are even worse. I mean, people may still remember my rant about emergent biosolutions, and the headline completely did not reflect what was happening. In fact, it was 180 degrees untrue about what was happening at that time in that specific instance. And here's another one. This one's not quite as nefarious as that one was, but in this one, you can read all about how the American consumer is tied up in knots and, full of angst. And the consumer confidence is basically at all-time historic lows. Yet in the meantime, take a look at that graph on the upper right. Discretionary spending is basically off the charts. You can see it's basically probably a quantum leap above the trend over the last 10 or 15 years. And that doesn't necessarily rhyme very well with what we're seeing. Now, some of that is supply chain stuff going on. We once again are having a little bit of trouble keeping toilet paper on the shelves here, and milk and eggs, and some of the various shelves and troughs at the grocery store are sometimes empty, but again, nothing earth-shattering or life-threatening. But
I think too, Mark, you can look at the business expectation of this too, and really see something different than those headlines, right? Business has its life at stake and needs to be right in the long term, not necessarily in the short term.
Mm-hmm.
I was just thinking as an illustration from Northwest Houston, where I am, to Central San Antonio, we went this weekend. There were no less than 6 Amazon distribution centers, and 4 of them are less than a year old.
Oh my!
They still had dirt around them instead of grass. So I mean, it's not new news that Amazon is expanding, and they have done very well through the pandemic as their deliveries have increased. But they are investing as if it's a permanent change, or that the growth will continue, not just stay but continue. They are not making do and working over capacity in buildings. It was amazing how often we saw the Amazon blue and white buildings go by, and they're not the only distribution centers by far in that corridor, right, but just popping up like weeds.
Yeah, and I think the same thing is true at Fedex. As Sean, as you did your homework, I mean, FedEx is having quite a challenge of keeping and retaining people and hiring people, and
yeah, that is by far their largest problem. Is there's work there, but they're just having to hire or outsource to other places, which is causing additional costs for them.
Mm-hmm.
But I mean, if we look overseas, they're actually looking to reduce their labor force out there, though.
Mm-hmm.
So they're going to be, as soon as they can get a grasp on their workforce, they're going to have plenty of work to do, and they'll start hitting their revenue and making those profits.
Yep. So anyhow, the message is don't stop at the headlines, and dig in a little bit deeper, and you're going to hear a little bit even more about that with the S4 from Footprint. All right, just a quick time out to talk about the groundhog. It is underway. It's now a couple weeks into the running, and Houston's George Mackey is threatening to run away. No, it's early. Matt confessed he wasn't concerned that George was going to get away, although they were 4 and 5 a week ago, I believe. It's kind of a slow start to the year, but we've seen this before. Actually, with 39% of the participants beating the market, that's a pretty good sign. And I don't know what the afternoon has done to us with what Len was talking about with the drop in the market. But the one statistic that really jumps off the page at me here is Kathy Wood's entry going from 49th to 150th. And again, I'm not being disrespectful, certainly don't want to pick on her, but my goodness. And that kind of, as I said, she owns in that ARC Investment Innovation Fund a lot of those tickers that were on that page that Sean provided. It's just quite a horrific run.
Yeah, you unfortunately pick those bad growth stocks. Yeah, they do great when market's green, but turn red real fast.
Nasty stuff.
People are first to flee from them.
A lot of familiar names on here. Notice that we did expand it down a little bit to capture Sean down there at 43. But
Thank you, Mark. I appreciate that.
on the leaderboard, kind of with an asterisk there, Sean, but you have to pick up your game a little bit. But a lot of familiar names, former, fairly recent champions, Andrew Spector, Curtis Sears, Sandy Castro, one of our all-time leaders. Again, it's just fascinating to see those same names percolate to the top of the list. And yeah, Ken Cavul is there at number 32. And my name is mysteriously missing, but we'll fix that. A little heat on the NASDAQ would help there. All right. Oh, and I did want to point out, number 2 is Graham Stephan's Monkey. That's that random selection that we talked about last week a little bit. And he has already turned himself into a new clear and present danger. Maybe we shouldn't have invited him to the party.
Monkeys for the win, I guess. Those apes have something there.
Let's see him do it 2 years in a row.
Yeah, we're gonna have, yeah, there you go. It's an ape. It's a monkey. There you have it. There's our alarm going off. It is 222 on 222. So I'm gonna take a sip of coffee.
Hey, we do have one question mark. Ann Manning asks, when will the full list of Groundhog participants be on MI? And I assume that's in the dashboard.
Yeah, in fact, I was going to talk about that next. Thank you, Ann. I've been going through and adding them. I've been a little bit distracted, but we're getting to that. If you go to the Manifest Investing website, on the home page, Groundhog 2022, the dashboard is available on the right. I've started loading from the top down based on the current standings. So I should have them done here within the next couple of days. And just a quick reminder, like I said, I started up at the top of the list. And just a quick reminder, these are basically frozen in time at the most recent market close, if you want to think of it as an approximate thing, unless we do an update, between the opening of the market or whatever, or during the day. These are typically going to be those one-time snapshots. So that's why these will not always match these exactly. These are basically pretty close to real time. They adjust all day long, and they adjust for all dividends and splits. So the official scoreboard is this one. And I think George's actually does line up to close as to when I captured this before the market opened. Yeah, and that it also matched his ending value. But again, I'll fill them out down to the bottom. There are about 170 entries, so it will take me a little bit of time, but next couple of days they should be there. And you can go in and check out what George has bought. You can check out Herb Lemkool's interesting portfolio that is hanging right up there at the top, along with the 5 random darts tossed by the monkey. All right, quick moment with our best small companies. No major news here. Some of the pressures are continued to persist in some of the same places. We have covered Boston Beer a little bit of late. We have talked about iRobot. Sharps Compliance, it's probably going to be all right, especially when some of the traditional discretionary elective procedures return to more people going back to the clinics and hospitals. I'm kind of hopeful that Green Tree Hospitality will see some mode of recovery now that the Olympics are over, and that the Chinese are not tightening down quite so much. I'm frankly amazed that they were able to avoid any Omicron-related mentions or incidents during the Olympics, and hopefully somebody's studying that carefully to see what's going on, although I don't think we ever want to tighten down as tight as they had to, but they did manage to pull it off. I didn't expect that. But that lockdown, that clamp down probably didn't do Green Tree any good here recently, and hopefully they'll be all right going forward. But any major news at Green Brick or anything that you'd like to share, Matt?
They have not reported yet, so we don't have direct comments on it. They did announce a week ago that they are entering the Austin, Texas area, which was the last major metroplex they weren't in, with a partner that I haven't been able to find out yet. So they're a 50-50 joint venture. But so in addition to expanding into Denver, they've gone into Austin. It'll be interesting to see what they, of course, in the further year, what they project for their growth to be for 2022. I mean, talk about headlines not matching. That was there was a Wall Street Journal headline that said, nationwide January housing starts were down. If you dig into that, that's because in the Northeast it was down 25%, in the West it's up 15%, and then the Midwest and South were mixed, city by city. I think overall the regions were down very low single digits, but it really it's not new news to hear that all real estate is local. So I expect they'll have strong news to come in. Whether that comes into the stocks or not, who knows?
Yeah,
I know my investment club just bought some more DR Horton on sort of the same similar sentiment.
yeah, and that comes up in the screen here in a few minutes. Yeah, and the example you just cited is another opportunity for averages to lie to you. You talk about a fairly low volume area with negative return versus where the higher volume areas are actually showing a gain. Again, be careful with what the headlines say and what the averages say, because a lot of times it doesn't reflect things. So I think Green Brick moving into Austin sounds like a pretty powerful strategic move. So we'll keep a good eye on that. So the other thing that's kind of interesting here is the number of companies that are outperforming the market is up to a little over half the group. So let's hope that they all catch a little bit of fire here. We've still got a long time to go between now and Halloween, so we'll keep the faith. All right, so let's spend just a couple minutes kind of reinforcing some of the stuff that we covered on inflation. I have shared these in the forum at Manifest Investing, some of the references, so you've had an opportunity to look at some of this stuff. But, again, boiling down the discussion that Ken and I had, it really comes down to this notion of, if you really are concerned about the uncertainty and the turbulence and the aspect of what inflation does or is doing to the market, keep doing what you're doing. Maybe even ratchet up the attention on up, straight, and parallel for a while until things cool down. And that's kind of the message here. Put the win button in there just so we could mention Gerald Ford, one of Michigan's finest. But actually it takes me back to an old Senior Bowl moment when I was in high school. That puts a date stamp on me and on that button. It had to be sometime around the mid-1970s. And I can remember a question coming up at the Senior Bowl that was interesting to hear some of the responses. And, of course, who doesn't like Mr. Jackson and Tommy Lee Jones? And I just wanted to underscore this cover jinx type thing. One of the more infamous covers, Barron's has several of these too, but one of the more infamous covers was this Business Week, Death of Equities at precisely the wrong time. That's from a midsummer 1982 cover for Business Week, just before 20 of the best years that the stock market has ever seen, just after that. And then lo and behold, wasn't all that long ago, just a couple of years now, they were asking if inflation was gone forever. And probably not a good idea to bring it up and talk about it. It may have jinxed us a little bit. But
I didn't see that cover from Bloomberg there, Business Week. That's definitely some, I don't know, some really bad foreshadowing there, because once you assume something is dead, I mean, it's going to come back with a vengeance probably.
Yeah, you got to watch it again. It kind of goes with the theme of the headlines, the magazine covers and headlines. Just be careful. I mean, I wish I had a copy of my Enron piece from I'm not sure what year that would have been now, but they were basically the business of the year, covered all over the place. And then there was another one from a few years before that with a company out in Idaho. It was on the covers of everything just before they completely cratered. So you be careful with magazine covers. It's the old community bias thing. But in that respect, we are going to take a quick look at this advisor channel, 4 tips to protect portfolios in a rising rate environment. We may actually come back and take a little bit closer look at it, but just wanted to share a little nugget to pique your curiosity and get you to take a closer look. But this notion of keep doing what you're doing, Nicholson's triple play, and Coca-Cola will cover that. And then I do want to just point out that this article that we wrote, it was actually on the the national convention in St. Louis a few years ago, and the photographer from the St. Louis Post-Dispatch, David Carson, he's cited there. He left me out of the picture. I still haven't forgiven him. But the thing we remember about that session, and this is so true with a lot of the stuff that we do, is our stock studies, when we include the business model analysis or the visual analysis, however you want to think about it, everybody here knows that a lot of what you need to know about the companies as you study them is right there. You don't even have to know who those companies are in those two little nuggets that I've shown you right here and right here to know that you would be interested in knowing more about the company. So no matter how it's presented, when you see up, straight, and parallel like this, and as it was pointed out in this article, and the audience is literally sitting there going, ooh and ah, just like they're at a July 4th fireworks show. I know you've heard the story, so I won't belabor it too much. And then we would put one up there that didn't happen to have earnings or whatever. We just all ziggity zaggity, and the audience would laugh. And so this photographer from the St. Louis Post-Dispatch, basically asked us, "Are you guys a cult? What am I seeing here?"
To reinforce what you're saying there, Mark, with that up, straight, and parallel, even when I was doing my presentation for our investment club on how to research a stock, my number one thing was, hey, is it up, straight, and parallel? This here is a big thing on what you want to see. If you want to make a stock consider worth investing in or looking into more.
Yeah, absolutely. And not only that, what are the threats? What could possibly go wrong to make it no longer up, straight, and parallel going forward? And that's all part of it too. So let's go ahead and launch into it a little bit. Here is the inflation picture shared by Ben Carlson in his article cited down here at the bottom. And in the article, he just basically makes the point, if you're wondering why things are so turbulent and maybe more uncertain than they ought to be, Ben actually makes the point that if you compare the year-over-year inflation as shown by the orange graphic, which has been, basically hovering down around 2% with some peaks and spikes and a little bit of a spike downward, but basically hovering somewhere in that 2% range. And then you compare it versus the 10-year Treasury, the yield on the 10-year Treasury, which has been steadily kind of approaching that over the years. We have not seen a period in history where this difference is as noticeable as it is right now. And it could be, I hate to use the word transitory. It's transitory in some way, shape, or form, but it's is it a transient? Is it something that's going to settle down and come back and behave itself? Probably. Don't know how long it'll take. And then just for keep in mind that the graphic that you're looking at here is literally just this part of this chart. So it's just the right-hand side of the chart. So other than this period in the 1970s, the whip inflation now period, and then a little bit back with World War II, that 2%, 2 to 3% number is a pretty good one historically. So again, I don't know what your thoughts are, guys, but it is, and just looking at the data, it is a moment. It's a moment that's causing some head scratching.
And 100%, it's what's even crazier is, and I said this earlier, was this percentage here of 7.4% for inflation. Mm-hmm. If we were actually using the original formula for inflation that they used back in 1980, it would be just as high as it was then at 15%. So this is it is transitory in some sense, but at the same time, I'm not expecting anything to change drastically.
Yeah, that's a really good point. Intel just reported a week ago too, or they just had not reported, but they had an analyst meeting that really hit the stock. And they also announced the big investment into Ohio, a $20 billion investment in a greenfield chip plant in Ohio. That's expected to come online in 2025. And that's always been something that's been interesting to me when you have sort of at the far end of the supply chain for technology industry, where you think things, you get a new iPhone model twice a year if they're doing one of the S models. You have these fast moving, fast changing tech end products, but they're mated to the integrated circuit supply chain was actually a long lead time industry. So to whatever extent the chip shortage is supply related, they can't make more, as opposed to demand related, that people are buying things instead of having services, it's years out.
Absolutely.
You know what? This might be another time too. There's another question, Mark, from Marty Eckerly, kind of building on our discussion of the home builders. He asks, with upcoming higher interest rates that might cause a slowdown in housing, what effect will that have on Essent Group, or maybe more broadly on mortgage lenders? That's what's kind of an interesting squeeze here. If interest rates are still low, even though they might be going up, and the 30-year is just under, or 30-year mortgage just under 4%, but inflation's that high. They may feel this disconnect more than others, because even if home builders are somewhat insulated, they're of course only about 1/3 of the home sales volume in the country.
Yeah, and I think back to times when I had an 8 or 9% mortgage, and I was drooling over my dad's 5% mortgage that he got, I don't know, back around 1965 or whatever, sometime that long ago. And the difference between that was substantial. But, and Ken has talked about this also, if the mortgage rates go up to 4 or 4.5%, yeah, it'll put a dent in things, but I just don't see it slamming the brakes on, or slamming the home building engine into reverse.
Mm-hmm. No, there's still a huge undersupply. Like there's not enough homes for people to buy still, so that's why prices are still going to be up.
Yeah, I think I could see a bifurcation, right? That certainly it should send it, and in fact, it sent a rush to refinance, right? The last people who were really holding out, thinking I could hold out a little bit more, might have a final, and I think there was actually a volume increase in refinances in January. Certainly, there would be no motivation for a family to refinance at this point and stay in their same house. If they were looking to move up, if their family was growing, that might be a disincentive, but they need to do what they need to do. So I don't think for building, or in Essence case, because they're providing mortgage insurance, I don't see that that's much different. I think anyone that's reliant on the transactions, the fees, which might get into more like title insurance, something like that, could see that.
Yep. All right.
Leo's got a question here in the comments saying that there's an article on Bloomberg today talking about the major layoffs in the mortgage refinance area due to a reduced demand to refinance.
Yep.
And that's some of the large volume that they've had for the last quarter that's accounting for some of that.
Yep.
And I've actually seen people receive offers, your mortgage is at 3.4%. Can we talk to you about 3.1? So that's how, I don't want to say desperate, that's how assertive they're pursuing that type of stuff these days. All right, let's go ahead and shift gears to a little bit. That first article that I shared from the Visual Capitalist, this is just one of a series of about 8 or 9 slides and some discussion that goes along with it. But I found this one kind of fascinating. Again, when inflation is increasing, would be the y-axis up here. So going up, increasing inflation along with increasing interest rates, which certainly qualifies. Obviously, you want to be looking for the groups that are in the upper right of this chart. And I'm really sorry that Ken is drinking, he's got his umbrella drink with his feet up on the beach, because, here's his banks and here's his financials. They're all still there. That if you can find a good, well-positioned financial company, it's still not insane to go after them. And you've seen us talk about some of the capital goods type stuff. Again, that's that, including autos, can be regarded as capital intensive, certainly economically intensive. These groups are leading the chart. Here's transportation. Sean, you guys were just talking about Amazon, but FedEx and the transportation type stuff fits in here too. And
yep. Well, Warren Buffett had it as any company that doesn't deal with a large amount of material or capital do well. So I was actually kind of surprised to see things like auto and components and materials there. But that's right there. It's too bad for financials, PayPal's not doing well with that.
Yeah, it certainly is there. Well, I think again the activity and the capital goods stuff may be somewhat supply chain related, but people are out there making fairly large decisions on new automobiles and you know, home remodeling and all that kind of stuff. They are being quite spending with their discretionary stuff. And then Len has actually launched a discussion on the forum, and I think we'll probably get into this a little bit deeper. Len Douglas, obviously the energy stuff has taken off also, and it's just kind of fascinating to see this laid out in this way. And a lot of our screening efforts are actually leading us in that area. We'll go there next. Any other thoughts on this, Matt?
No, I mean you could also chart the reverse, right? Where if you circle Kathy Wood's holdings, right, they're in the opposite area right now. So this correlates with that example anyway.
Yeah, and look at how much EPAM and some of the professional services companies have had quite a serious run. And that's just basically telling me, Mark, don't be surprised if that cools off a bit. You know, I'm not going to lose any sleep over it. It's going to cool off. And I mean, look at these guys here. You're right. This is where Kathy spends a lot of time, on the left-hand side of this chart. And down to the bottom, too, down here, obviously. All right. The other thing that we mentioned last week, just in passing, this notion of, back in the depths of one of the worst inflationary environments in history, George Nicholson basically wrote this article about picking Coca-Cola using the triple play. So we wanted to reinforce the triple play here a little bit. Basically selected it, and then clubs debated it. While they were debating it, it actually went up like 80% over a few months. And he wrote about that a few months later. Stop twiddling your thumbs and trust me. The time to basically go after some of these companies, especially if we hit anything which resembles recessionary conditions, is to embrace this triple play notion. Here's a look at Fedex. Sean has covered Fedex in one of the shorts we'll talk about here in a few minutes. But the triple play, and just to reinforce the triple play, Nicholson said, especially during bear markets and recessions, and you could even throw the inflationary environment in here a little bit. If you go out there and you look for companies that basically meet three characteristics, the first being a depressed stock price, which leads to elevated return forecasts. And that's what you see here with Fedex. I think Fedex is down closer to 200 right now, if memory serves. And this is only from a few weeks ago. Fedex was actually in the value line update last week. So I think Fedex has actually lost another several percentage points since that value line report came out. So
yep, currently sitting at 217.95.
217. So it's actually down from here, which means these numbers are actually higher. So again, respectable return forecast. And that's also displayed by the price shown here being below that long-term value line, which is basically a trend line based on price to cash flow. And so anytime that it's actually notched downward, it could be time to give it some thought. The second condition you want to watch for is the opportunity for multiple or PE expansion. Again, a current PE down closer to 10 or 11, projected to go up to as much as 18. So that fits criteria number two. The third is to basically look at the characteristic or the behavior of the company with respect to profitability and basically margin enhancement. And the company has been down around 3, 4, 5, not quite reaching 6, and then out here projected to be a little bit greater than 6. So it actually, even if it's just, that's kind of a gentle qualification, all three conditions are basically met. This is obviously a no fly-by-night company. Well, actually, they are a fly-by-night company. That's a pun.
That's the cheapest way to fly.
So they are a fly-by-night company. What am I saying?
Hey, they actually purchased 20 Boeings, 10 are to be delivered in 2024, and another 10 in 2025. So
You know what I mean? These guys just didn't
they got
follow up the
my line.
turnip truck, although they probably have turnip trucks. I don't know. I'm going to stop now. All right.
Actually, I'll say the market for cargo planes is so strong and is such a key component of wide body demand now that Air Lease actually for the first time put in an order for they're a launch customer for the A350 freighter version. So freighters used to be sort of after nobody would want to fly on them as a passenger, you made them a freighter,
Yeah, right.
and kind of dealt with it. And they were noisy and dirty and whatever. They're actually talking about not just converting all those wide bodies that don't fly over the oceans anymore, but significant demand for new freighters.
Moving stuff from point A to point B, it always works. All right.
Yeah, avoiding ports.
All right. Quick look at this one. This is one thing that does give me the heebie-jeebies a little bit, highly technical phrase. This is just a look at the number of new companies making new lows versus new highs. More new lows means that this kind of maroon area goes down. The blue is the trailing 12-month average of that line. So we look at that a little bit and just notice that this is down into maybe a little bit of concern. Obviously, there was quite a bit of concern here in that snapback moment that we had back in March 2020. And this, of course, is the grand kahuna of all time, one of the worst moments in stock market history. And again, you did have a considerable amount of time to basically get protective or buy some of the different kinds of stuff back at that time frame. So it just, to me, this just keeps me a little bit more focused on up, straight, and parallel right now. Not that I'm not always out there looking for less traditional opportunities, but I'm going to spend more time on that. So I thought I would just share very quickly the results of a quick screen, core companies, and triple play qualifiers. And I'm not going to go over the list top to bottom other than to say, just to give you a quick definition, we consider potentially a core company to be one where the quality plus the financial strength plus the earnings or profitability stability adds up to a sum greater than 225. That's the number that you see here where it says core question mark. So if you want to dig into that and see what you can discover, that's there. And it's a pretty interesting list from top to bottom. You've already heard mention of D.R. Horton, Boston Beer. Here's one of those car companies, Car-Mart. Fedex is on here. And there's just some good studies from top to bottom. Might be interesting to throw Expeditors into a side-by-side comparison of FedEx. And other small companies, Malibu, MKSI, I think that position is fairly well positioned for the coming months. And then lo and behold, here is Google, one of the probably more staunch tech companies out there. So again, just offered as an example of a way to think about what do you do when it gets like this. There's a lot of companies that are in the upper right of that chart that was shown, and just kick it around a little bit. All right, so with that, again, just reinforcing that we're looking for companies that are beat up, not falling knives versus those catching those pendulums going the wrong way. And that's why we do pay so much attention to RSI and why we have talked about it recently. We'll cover that in more detail soon. One question that I did get fairly recently after we put out the Fave 5 based on the low RSI last week was, where can I find a list and for free? So I went to finviz.com, selected the technical bracket here, or the button, and just went in and said, show me the oversolds. And I added the RSI's oversolds 20 or less, came up with this list. The one thing I would caution you is maybe don't look too quickly or too hard at the penny stocks on here, but companies like 3M, Black Knight's probably worth a little bit of a look. And it can be a way to discover that pendulum opportunity, not necessarily falling knives. Quick look at 3M. Yeah, they've had some bumps, but pretty steady, pretty up, straight, and parallel, even if it's the more tame version of growth, but definitely a blue chip company. So just a quick Warren Buffett moment. There's a bunch of Buffett stuff out there with some wonder stuff. I'd encourage you to read it. We certainly respect them, but I mean, even Warren Buffett, his company anyhow, is doing some fairly unusual things, investing in rat poison. So we'll probably come back and talk about that a little bit more when we talk about the Bitcoin and the cryptocurrency stuff in the future. So with that, I thought I would invite Matt, because he's basically unearthed the company that I'd never heard of before, known as Footprint. That's one of the most famous footprints in the history of cinema, so I included it. And let you take it away, Matt, and just kind of share your thoughts on Footprint for the next few minutes.
Sure. So I do have a lot of information on Footprint, and most of these slides are in the forum post on there. And I'll be adding a few things right now. The S4 statement, which is the registration statement for a SPAC. So yes, this is my third SPAC, and the second with the Gores Group. Just came out a week ago Friday, so I'm about a third of the way through it. If you had a physical copy. The last two I've had have been greater than 2 inches thick. So there's a lot there, but there's a lot that repeats too. It's sort of like an S1 statement, which would be like an initial kind of 10K for a company, but it's for both companies. So Footprint as an operating company, and then the SPAC itself, and its process of identifying that as an acquisition target. So just to start with, so Footprint was started in the Phoenix area. Its CEO and a large number of its technical and senior management group are actually ex-Intel people. They're out of Intel's packaging engineering group, and the backstory is the CEO Tony Noto was studying contamination from the packaging used by Intel on its chips, and realized that the same sort of plastic trays that they were using was used in food as well, and started as his own kind of personal side project, but with the kind of equipment that Intel's packaging engineering department had. Started looking into and getting motivated by the idea that these plastics not only end up in chips, but end up in your body when you have the same plastic in there. And thus was born an ecological or a green company. So this is Footprint Center. They have sponsorship rights for the home court for the Phoenix Suns, rather than just simply being a vanity labeling or advertising like most of these are. Footprint actually has some a hand in the operations, so they actually use footprints, and what they have is essentially 100% plant-based food containers. They actually can contain other things as well, but in this case it's food containers. So no plastic lids, no plastic silverware, no plastic bowls. They use that in the concessions at the Phoenix Suns, and then also Footprint has the ability to place its own customers' products into those concessions, sort of as a showcase, to the extent that Phoenix is not only a technically minded city, but also an environmentally minded city. It gives them sort of a flagship way to peak advertising. All right, next slide. So this is kind of the nuts and bolts of what it is. Again, looking not only to not be primarily made of plastic, but how most fiber-based products handle this is they may have a plastic liner or some sort of sprayed coating, which does reduce their plastic usage greatly, but sort of ruins the idea that these would be recyclable or compostable. And these are all certified by an outside party. And we talk about compostable industrial composting, not just backyard composting or recyclable. They do today, one of the things the S4 clarified for me, they do today come from virgin fiber sources. So they are not recycled to start with, but they are beginning that. They're beginning to include recycled fiber this year, and have a target to get up to 40% recycled content into it by 2024. So there's a lot of detail here. We can skip this one in the sake of time.
You definitely had me at microwave safe.
Yeah, one of the pictures on here, and you can see it. You can see in the upper right the shelf-stable cup. That's an Annie's mac and cheese cup, and boy, I went looking for that, wondering where that would be out now, and I can't even at Whole Foods I can't find it. We do have there are a number of places you can see their product now. So Healthy Choice has a line of power bowls. Those use Footprints products. Believe it or not, Hungry Man has a line of bowls. Those are also Footprint. And also P.F. Chang's uses that as well. And then if you happen to have a Sweet Green restaurant near you, Sweet Green is a kind of a Panera-ish salads and warm bowls restaurant chain that just IPO'd itself in November, but is I'll say nationwide, is across the country. They also use Footprints items for their to-go orders, to-go and delivery orders. So there are a few places you can see it now. It is about $50 million revenue this year, and growing to 500 million plus in 2023. So growing like a weed with committed orders. They also just had a conference where they announced some award winners, which is really customers. And Albertsons actually was cited as rolling out their supermarket trays, their meat trays, actually meat and vegetables, packaged vegetables throughout the chain as well. So if you have Albertsons near you, you might look out for that. Next slide. So this is the customer list, an excellent customer list. Like I said, and the bottom, they're contracted for 580 million. That's for delivery by 2023. They have a whole bunch more of, and all these are, household names or significant names in the business. You might not recognize, for instance, JBS. They're one of the biggest meat packers in the country. Mm-hmm. Walmart certainly is also looking. Haven't had an announcement and looking for it. Walmart is expected to move all their meat trays to this product here. That's a little bit of volume. Mm. But that contracted volume is coming up quickly. I'll also say, and this, so first point, a number of these customers do, and it's not unusual for a tech company to feel this way, do have equity in their customer agreements. So as they order more, they'll get some interest in the company as well. Those details aren't specified, but one surprising thing out of the S4 is that I found out that Koch Industries actually was a competitor to Gore's, had interest in actually buying Footprint outright, and will end up instead investing $150 million, so almost 10% of the company will be owned by Koch Industries. So if you imagine that as a very practically minded industrial interest. Next slide, yeah. So this is the revenue growth. The green is contracted revenue, already contracted. And this was as of November. The orange was potential. But you could see, so they're counting on, if you look at 2023 estimates, they're counting on 500 million. They really think it's 1.5 billion. They make a big deal to say they're oversubscribed, which is a quality problem, but a problem, meaning that it really depends on how fast they can grow to see if they can deliver what they think customers want. And there may be some amount of customer priority or opportunity for competition if they're not able to meet it. But an excellent time to have.
So, Matt, do they discuss, production capacity and, I hate to say it, but the footprint of, manufacturing?
Yeah, that was one of the slides I had in there. I can't. I was just thinking about that. I'm not sure if that comes up in what you scraped off there with their locations. Did you?
I don't think I did.
Might be coming up.
Okay.
You don't think you did?
Just kind of hold that thought. I don't think I did.
Okay. Well, I can mention it. So their primary manufacturing location is Mexicali, Mexico. If there's one critique I have of them is so they are currently expanding that from a size of 100,000 square feet to 1.5 million square feet, and it's kind of all eggs in one basket for me. I would have rather have seen them, particularly with meat packing as a potential large customer. I would rather seen them, at least a point. Not on the Baja Peninsula, and maybe even in the Midwest U.S. To just try and spread out any kind of weather event or other localized disruption. Obviously, it makes sense to be in the California area with how much the Central Valley means for agriculture. Mm-hmm. But they're a little bit kind of too concentrated there. They actually almost a little over 1/3 of their volume in 2021 was actually produced subcontracted in China. So they actually have a number of their quick serve products are able to be made by subcontractors. They're not as worried about intellectual property there. The other news out of the S4, they also are planning an entrance into Europe, and they have a location picked in Poland for that. They're going to have offices in the Netherlands and engineering, and they're going to have a production facility in Poland. That was scheduled and is in this presentation scheduled for 2023, but as of the S4, that's actually going to be going live at the end of 2022. So that's actually being pulled ahead a year. So they are doing their, and of course, if there are supply chain disruptions in the delivery of goods, you can imagine what they are in the terms of building buildings or delivering items that make goods.
Yeah.
But they seem to be a little bit ahead of their plans in expanding and meeting that perceived demand. Now, the bad news, so this slide is one I made, and it's based off the 2 years of pro forma results for 2019, 2020, and now 2021. And then 4 years projections 2025. This is revenue and then EBITDA, so not full earnings, but EBITDA kind of being ahead of that. And for all the conversations we've had in this forum, talking about those early S-curve companies, you can see where they are. I expect with more investment this year, 2022 is going to dip down, but then the lines going into the out years should go up higher as those investments pay off.
All right.
Yeah, so we talked about this. This is more detail on the arrangement with the Footprint Center, the partnership with the NBA. Just also know that there's a potential to take the concessions side of things and go further into other NBA venues for that, but nothing's come of that yet.
Okay.
And I will post more, as I said, I'll post more that I get from the S4 probably yet this week into the forum. Let me see. Well, I know we're past time. We can take. There's a couple questions. We can take that afterward.
Okay. Yeah, we're still at 3:00, so we'll just kind of wrap things up. We can certainly come back to, and I'm sure this is not the last time we'll be talking about the company. I'm impressed with how embryonic the company still is, but they do have such this infrastructure of talent and presence, especially the ex-Intel stuff and everything. And it's just fascinating to watch one so well positioned, again, so embryonic. So it'll be fascinating to watch it. Right, here's your reminder that we do post these sessions on YouTube, including all the bull sessions and the roundtables and the successful investing conferences. But Sean has actually been tinkering with these, he calls them 45 seconds. They're actually 60 seconds or less. And he's added a Boston beer, just a quick look. And it's, again, you can't do a lot in 60 seconds. But I'll tell you, one of the things I want to take on as a challenge is try to come up with, as Peter Lynch has pointed out in his books, the One Up on Wall Street and the other parts of the Lynch trilogy. He thinks that we ought to be able to describe a company and the key considerations around that company in just a couple of minutes. We're going to try to boil that down for a few companies, including updates, and see what we can do. So Peter Lynch said we can do it. And again, using crayons. Describe it to me like I'm a 5-year-old. Use crayons and do it quickly. And that's kind of what Sean has taken on, and we're just kind of going to see where it goes. What are your thoughts on it, Sean? Sean, are you still able to be with us?
Yeah, I'm still here. Yeah, no, this is you said challenging, and it has been very challenging to try and. The hardest part is writing the script out of anything to try and narrow everything down to 60 seconds. I say 45 seconds only because probably between the intro and the brief outro, that's all I have is 45 seconds. But it's worked out pretty well, and it's definitely has challenged my speaking ability to speak that fast in such a short amount of time. But more importantly, to get to the meat and potatoes of these companies, because as we were talking about earlier, that mainstream financial media isn't talking about certain things when it comes to Fedex or Boston Beer, and things are just getting thrown to the side that should be considered. Yeah,
so we'll be trying to tackle a few of these. I'm going to actually do some topics specific to manifest investing, like, looking at a chronicle and just, give you an access to the nutshell version of a number of topics like that, dashboards for clubs, that sort of stuff. In this nugget fashion. Again, we're a big fan of crayons at Manifest Investing, so check that out. They do actually show up when you go to click on the videos. They actually show up in the stream up here. But I believe after you watch them, I'm not sure they stay there, but on the regular home screen, this home screen, the shorts are always right here. So, and
they do stay there. Even after you watch them, they'll be all the way down at the bottom waiting for you again.
Mm-hmm. And they'll be scrolling as we add to them. I assume they'll scroll up much like the others. All right, here's a reminder that a month from today, we do have our black tie, red carpet. There are already people lining up, and the line is already forming to come to the round table a week from today when we have our awards ceremony. And last but not least, I received this picture from Kim, and I had to put it up here because Ken is not far from there. And just a beautiful orangey sky from Florida. And Kim and Ken send their best regards. So with that, I think I will go ahead and shut down the recording, Matt, and we can stick around for a few questions. So thank you, Sean. Thank you, Matt. And thanks, everybody, for sharing some of your time with us here on this Tuesday afternoon that is wild with twos. Take care, everybody.